Hi everyone, thanks for joining today's webinar. I'm Jess Wright, Head of Partners and Clients at Sharesight. And today I'm joined by Pat from Six Park, one of our partners. He's the co-founder and co-CEO of Six Park. Six Park is a leading provider of online investment management, also known as robo-advice in Australia. Six Park provides investors with simple and streamlined access to cost-effective global diversity and professionally managed portfolios tailored to your risk profile. Pat co-founded Six Park in 2014 after a 25-year career in financial services industry. Pat worked at JP Morgan in the US and Australia, where he was involved with managing the global privacy and private equity investments. Sorry, I'm mixing my words today. And had a specialist responsibility, investment strategy and portfolio management and reporting. Today, Pat is going to talk to us about ETFs, one of the fastest growing investment vehicles. With more than 200 listed on the ASX, I'm really not doing very well today. How do you select the best ETF? And more importantly, what do we do with them once we have them in our investment portfolio? Today's webinar is information purposes only and does not constitute a product recommendation, taxation, or financial advice. And we recommend you talk to your accountant or financial advisor for your own personal situation. And with that, I'm going to pass it over to Pat, who hopefully won't have so much problems talking like that.
I probably will, Jess. Let me see if I can at least get the share screen correctly. Okay, terrific. So I'll get started. Welcome, everyone. Thanks for joining today. I am Pat Garrett. I'm the co-founder of Six Park. I won't repeat what Jess just mentioned other than to say that we use ETFs to construct the portfolios that Jess referred to. So we are strong advocates of ETFs as portfolio construction investment tools. So appreciate the fact that everyone's taken a little bit of time out of their day to listen to what I will touch base on. I'm going to try to go reasonably quickly so that there's time for questions at the end, as that frequently surfaces some of the more interesting discussions, then I'll go on. But hopefully the slides that I walk through you'll find informative, and happy to follow up on any of it. Jess already gave the disclaimer, so let's get right into it. The first point I'd like to make is that the investing world is fundamentally changing, especially in the last several years. Most of you on the call would be pretty familiar with the active versus passive debate that goes on in the industry. There's probably no definitive right answer there, though there's certainly a lot of data that supports why ETFs and passive based products have grown so much in popularity. COVID-19, especially in Australia, has really amplified the need to be thinking about the things that we're going to talk a little bit about today. Robinhood in the States, with the free investing and the popularity with people having a lot of free time, not being able to gamble, and deciding that day trading is something they want to have a crack at. There is nothing inherently wrong with that, unless you're doing it with a sizable portion of your investable assets, in which case it's a pretty high risk endeavor. And then finally, technology is changing the landscape of investing. Services like Sharesight, which I assume most of the audience is familiar with, and Six Park, and other fintech services and tools have materially impacted the accessibility and affordability that people have to set up, manage, and look at their investment portfolios. And technology is actually the driver behind the creation of ETFs, exchange traded funds. Index funds have been around for a while, but their availability and diversity of types has really skyrocketed in the last couple years, and that's really because of sort of technical innovation. Just a few factoids, I guess. If any of you have not looked at the ASX website that has information on the exchange traded fund market, I would highly encourage you to do so. The URL for that is in this presentation. As Jess alluded to, these charts just demonstrate the rapid growth over the last 4 or 5 years, both in dollar value and number of ETFs listed on the ASX. It's over 200 at this point, growing at a phenomenally rapid rate relative to other forms of managed funds. This is just a print screen of the ASX Fund Report that will provide you with a wealth of information on every listed ETF in the market. So again, as a source of information related to some of the things that I'm going to touch on, this is a resource you should definitely be looking at. Everyone loves a Warren Buffett quote. I think everyone's also aware that he is a big fan of low-cost index funds and has, to some extent, put in his will that the remaining cash of his estate be put into an index fund. I don't frequently get to be on the same page as Warren Buffett, so I like to throw myself in here and say that I think ETFs are pretty good too. So that's my way of trying to be on the same slide as Warren Buffett. So what exactly is an exchange-traded fund? For those who may not be aware, an exchange-traded fund is one fund that tracks an index that can comprise a bunch of companies across several countries or several currencies. And it's listed, as its name suggests, on an exchange in the ASX as well as overseas, obviously. So through one trade on one exchange, and in this instance, one currency, Aussie dollars, you can actually get access to one fund that tracks a lot of companies, countries, or currencies. Put another way, it brings together the best of two types of investments. If you own a stock, one of the attributes of it that's good, positive, is that it's traded on the ASX, so you can buy or sell it anytime during the day. Traditional mutual funds provide an element of investment diversification, but they can be a bit harder to buy and sell if and when you want to, because they're not listed on the ASX. Exchange-traded funds really combine the best of those worlds. They involve diversification in a fund that's traded like a stock. So the benefits of an ETF, they help you easily create investment diversification across global asset classes. Because they track an index, as opposed to an actively managed fund that is buying and selling shares on a regular basis, therefore has transaction costs, and has typically a group of investment fund managers that get paid to attempt to try to outperform the market. They tend to be, anywhere from 1 to 1.5% in fees. ETFs can be as low as 5 basis points. In the Six Park portfolios that we put together for clients, we utilize up to 8 ETFs, and the average management expense ratio or indirect cost is about 25 basis points. So they're very cost effective. They're listed on the ASX, as I mentioned, so there is, generally speaking, strong liquidity behind them as investment vehicles, and they are a very efficient way to construct diversified portfolios. And for those of you who haven't heard of modern portfolio theory, basically the Six Park investment philosophy, I wouldn't say is modern portfolio theory, but aligns with it in that the two most important things that an investor should think about, in our view, are having the right investment diversification or asset allocation, and keeping your costs low. So ETFs work quite well in that regard. And I mentioned the S&P and Index versus Active Report Card, or SPIVA, which some of you may have heard of. The S&P does a regular benchmarking of active fund managers versus the index that they are meant to track or effectively outperform. And without going into all the detail, I'll just say that a shockingly high number of active fund managers after fees underperform the index that they're meant to be outperforming. So that sort of begs the question, why not just buy the index, which is the point of ETFs? And then the last benefit I'd note is the transparency. Because of the relatively simple way that exchange-traded funds are technically and from a product construct perspective are set up, you can see what index they are in terms of the information they provide. You can actually see the index that any ETF is tracking and the constituent components. So an obvious example of that is the State Street ASX 200 ETF. Not surprisingly, it's tracking the ASX 200, therefore the 200 largest companies in Australia. Same could be said for an S&P 500 over in the States. You know exactly what's in the index. So the transparency is quite critical. Lack of transparency has obviously been a big problem in the financial services industry, broadly speaking, and particularly in funds management. There are risks with ETFs, to state the obvious. The first being market risk. ETFs have the benefits I just mentioned, but if you buy the ASX 200 ETF and the ASX 200 goes down, your investment's going to go down. So you are tracking market segments, geographic segments, currency exposure, and whatnot. And if those indexes go down, the ETF will go down with it. So it's not like a zero risk proposition. I mentioned transparency as a benefit of an ETF. As the ETF market's grown, not surprisingly, more exotic types of ETFs have surfaced, and I'll touch on that in a moment. And in some instances, some of the more exotic ETFs, the index is actually a bit difficult to understand how it works. So all I'll say is, if you're considering ETFs, and I'll touch on this in a moment, and you do your research and you read about the index that it's tracking and you don't understand it, that's a pretty big red flag. This is a related point, the third one. If it looks too good to be true, it probably is. You can get burned if you don't do your homework. More on that later. Again, as more and more ETFs have hit the market, they've become a little bit more, I guess, exotic or complex than the original sort of ETFs that I mentioned. And so you do need to do your homework. And again, I'll give some examples of that in a moment. There could be liquidity risk with some ETFs. Market makers are the entities that provide liquidity for the issuers of the ETFs. And typically an ETF will have more than one market maker to create competitive tension, to issue units of the ETF to match buyers and sellers, and that's how liquidity is created in the market. Small, relatively exotic ETFs. So if there was, I'm making this one up on the fly, if there was a sector of the cryptocurrency market ETF where the underlying liquidity of the underlying securities was low, you could have liquidity risk in that kind of ETF. So you'd want to do your homework on that as well. And then the last point isn't so much a risk as much as since you are tracking an index of multiple constituent components, you're effectively taking the average of that index in some way, shape, or form. So, for example, if you're tracking the S&P 500, what you have to accept is you'll never get the best of those underlying components. You'll get the average, so to speak. So some people just don't like that concept of tracking an average, so to speak, and want to seek out and try to select the best of a component group. So that's just something to keep in mind. So the headline title of this webinar, How to Choose the Best ETF, I think there's sort of two segments to the answer to that. And the first, a very, very, very important one. Best is different for different people. So I think the first thing you need to do is figure out, what does best mean for you? So just to use an example, if your priority is investing in a defensive investment where capital preservation is your primary objective, the best emerging markets shares ETF is not necessarily the best ETF for you. So I would suggest the first thing you want to do is think about asset allocation. Think about your risk appetite, your risk profile, and capacity, your time frame, which is a very important aspect. Are you investing for 5 years or 25 years? And use that as a way to frame how much growth versus defensive exposure you're comfortable with or you think is suitable for your situation. I won't go into the details of how that works because of time. Six Park has an assessment that asks questions related to risk capacity, risk appetite, time frame, and a few other aspects, and will provide a recommendation. You can do that without having to make any commitment or open an account. And there's other tools that will help you with that, but I would suggest that's the first thing you want to do. Then you want to think about the ETFs that you might use to build out that growth and defensive portfolio and diversified portfolio. This URL that is on the bottom dot point will lead you to this print screen that I showed you earlier. Once you've done that, how you choose the best ETF. So this, for what it's worth, is one of the mandates for Six Park's investment committee, which is involved in determining, our investment committee is involved in determining asset allocation across the portfolios ranging from conservative to aggressive growth, the asset allocation into the different asset classes, and also choosing the best ETFs. It's an incredibly important role for a service like Six Park. We are highly automated, driven by technology to help keep costs low, but ultimately there's a human overlay that is very important in the delivery of an investment management service. One of which is on this screen is picking the ETFs. So these are the primary criteria the lens that we see ETF selection through. Relative costs, we're obviously advocates of keeping costs low. The lowest cost ETF is not necessarily the best ETF because of these other factors, but certainly you wouldn't want to pay 4 times the amount for one ETF than another that does the same thing, to state the obvious. Tracking error relates to the extent to which the ETF actually mimics the index that it's meant to track. And for those that are satisfied most of the dot points below this point, the tracking error should be fairly low, but it is something you want to have a look at, because if you're paying to effectively track an index, but the fund isn't doing that, you're not getting what you're paying for. The size of the fund is a relevant consideration because if it is too small, then aspects of liquidity and tracking error can rear their heads a bit more quickly and when markets get volatile. So on balance, the larger the fund, the better, although that's not an absolute rule of thumb. But if you had the choice between a $1 billion ETF and a $2 million ETF in terms of market value, you'd probably go the larger one. The track record of the fund and the issuer. Most of you would be familiar with the likes of, and these are the ETF issuers that we use. We're agnostic. We just pick the best ETFs we can, and we happen to have landed on the top 5 in terms of number of ETFs and market value, and that's State Street, BlackRock, Vanguard, BetaShares, and VanEck. They've all been in the market for a while. They all have had funds in for a while, and they've proven that they know how to get market makers to create liquidity, et cetera, et cetera. So you can have a look and see the track record of the issuer, transparency of the index construction and the fund objective, any ETF that you are thinking about, you can do an easy Google search and do fact sheet on that ETF, and you'll be led to a 2-pager that will talk about the index construction and the objective. It's a really easy piece of homework to do. Take a look at that. If you don't understand that what the index construction is and what the objective is, again, red flag. Bid-ask spreads and trading volume liquidity, that's in the ASX report. Have a look at that. Most of the ETFs you'll see in that report, if you look at that column on bid-ask spreads, will look fairly similar. If you're thinking of an ETF and you look at that and there's a really wide spread between the bid and the ask, I'll do some homework as to why. And related to that is the number of market makers. I touched on that before. A quality ETF will typically have more than one market maker. Those are the entities that provide liquidity for the ETF. If there's more than one, there's effectively sort of competitive tension, which creates more liquidity for the ETF. You can find out in the fact sheets the market makers for the ETFs, and if there's just one, I'd be concerned about the underlying liquidity. How have ETFs performed during this incredibly unique 4 or 5 month period in the markets? In terms of liquidity, they've performed very well. There are some people who, prognosticators in the market, who suggest that ETFs, because they've grown in size, and the ETF market penetration in Australia is actually fairly low relative to overseas. It's, I think, 4 or 5% of kind of the market value. It's 25% and growing in the States. And because when ETFs trade, they trade all the constituent companies that are in the index. Some people believe if there's a mass sell-off of ETFs, it'll rapidly accelerate a downturn in the market. That's actually proven not to be the case for the most part. And what's happened is when markets got volatile, people moved across ETFs and asset classes as opposed to just selling to cash. So people holding individual stocks who sold tended to be create more volatility in the market than ETFs. ETFs actually created liquidity. In terms of the performance aspect, as in return, that depends on what asset class your ETF's tracking. If you owned a technology ETF in the last 3 months, you've done really well. If you own a transportation ETF in the last 3 months, you probably haven't. So I guess it sort of depends on how you define performance, but they track what they're meant to track, and they will. So they've performed well in terms of doing that, but it just depends on what your exposure's to. I put on here our client behavior and some information related to that because I think it's important, and this is related to the point underneath it. Generally speaking, people, and there is some data, Six Park data as well as other data, and I think this is also within some of the research by Sharesight. People who have done their homework and decided that ETFs are investments they want to use as part of their portfolio construction have generally shown an appreciation for the concept of diversification, low cost, et cetera, and very importantly, patience in the market. And if you own individual stocks and the markets tank, it can be a very emotional roller coaster ride. And with ETFs, there's a bit more of a smoothing of that volatility. And so retail ETF investors have typically shown a bit more discipline in the way they've responded in volatile events. So in Six Park's instance, our churn rate rose a little bit during the worst of the past 3 or 4 months, with most of the people who sold down asking to just keep their cash on the side to get back in the market. What a lot of our clients did is they retook the risk assessment and maybe changed their model portfolio up or down the risk spectrum, but remained invested. And a lot of our clients topped up their accounts. We're not big advocates of timing the market. I would call that more dollar cost averaging, because most of our clients do that anyway. They periodically deposit over time. Since our service is generally for medium to long-term investors. If you're looking to sort of find the next afterpay in the next month, our service would not necessarily be for you. So what might you do with ETFs once you've done your homework? I just thought I'd try to bring that to life a little bit by showing what our balanced portfolio looks like. We use 7 ETFs across 7 asset classes, which we put into growth and defensive categories. And so Australian shares, international shares, emerging market shares, global listed infrastructure, global property, fixed income bonds, and cash yield. Global listed infrastructure, we believe on balance, it's debatable. On balance, it's a defensive asset class, though it does have characteristics of a growth asset class. It has not been as defensive as it historically would be because of COVID and the fact that airports and transportation fall into this asset class. That said, typically it does show defensive characteristics. So by buying 7 ETFs, you can create a well-diversified global portfolio with a 60-40 split between growth and defensive, which for some people is a very nice portfolio to have and let work over time. In terms of what that looks like geographically, through just buying those 7 funds, and I know VGS, which is the Vanguard International Shares, it has over 1,500 holdings in it. So this is just a graphical representation of the type of exposure you get, both in terms of types of asset class, but also the reach around the globe. How can ETFs fit into different types of investment portfolios and strategies? This is, I think, a pretty important slide. Most of you, I think, by definition, probably have a bit of active investment management in you and stock selection or fund selection. And with ETFs, I've already touched on a couple of these points, but you can construct a mix of growth versus defensive assets very efficiently with ETFs. Within growth assets, there's income tilted or characteristics of an income growth asset versus, I guess, a capital appreciation characteristic. And so you can sort of, depending on your situation, you can use ETFs that delineate between those two. I'll touch on in a moment. You also have the choice between what I would call the 100% passive versus smart beta or active-like ETF approaches. The 100% passive would sort of be like the ASX 200 or the S&P 500. I don't mean this in a derogatory way, but I'd call that sort of plain vanilla, pretty straightforward ETF, but quite effective in portfolio construction. But as I said, some more exotic, speculative ETFs are in the market. You can use those as well. The last one I think is probably maybe the most important point on this page. We're hub, spoke, core satellite, whatever you want to call it. A lot of people like to research stocks, pick stocks, pick sectors, actively be involved in their stock selection. There is absolutely nothing wrong with that, as long as you know that that's pretty risky. I referred to the SPIVA data earlier. Picking stocks and timing the market's really hard, even for the experts. But I also realize that a lot of people like to do it. I just think that it can be really prudent to have, say, a diversified portfolio of ETFs that you reinvest dividends and periodically rebalance, which I'll touch on in a second, with arguably a significant portion of your investable assets, and then do the speculative stuff on the side. So that would be the spoke and the hub and spoke, or the satellite and the core satellite. We've seen a number of people pull down 10 grand out of their super and decide that day trading is the game for them. That's a worrying phenomenon. For a lot of people, that's a significant, particularly some of the younger cohort, that's a significant portion of their early stages of their retirement funds. And most people are going to lose that game eventually. And some of that money lost today for somebody who's young is a lot of money lost down the road, given the time value of compounded interest. One of the aspects I just wanted to cover real quickly, because it's either underappreciated or not utilized very much in the typical investor's mindset. So I just thought I'd try really quickly to articulate what portfolio rebalancing is. So what it really involves is buying or selling portions of your portfolio holdings to get back to your target growth defensive target asset allocation. And drift causes movement from your targets from day one as share prices or fund prices go up or down. So here's a real simple example. Let's just say, for the sake, really simplified here. Let's say, for the sake of argument, you make the decision on it, day one, that you want to have 60% of your portfolio in growth assets and 40% in defensive. And at the end of the year, you actually have a 50-50 split based on market movements. So in this instance, growth assets having gone down and defensive assets having gone up. What rebalancing involves is selling some of what's gone up to buy some of what's gone down. And that's a bit counterintuitive to most investors and from a behavioral perspective, because you think, why would I sell my winners to buy my losers? And without getting too technical, it's sort of based on mean reversion, that eventually the losers will come back to at the asset class. Underperformers will come back, will revert to their mean performance, and the outperformers will do the same. And it sort of automates a sell high, buy low, and keeps you in line with the risk profile that you've determined is appropriate for your situation. You don't need to do this every week or month. There's research that suggests once a year is enough. Six Park does it up to 4 times a year for clients at our cost, which is definitely, in our view, enough. You can drift in and out of your target allocation. You don't need to trade every time. You start to build up. Even though it's at Six Park's cost, you can end up over trading if you rebalance too often. But at least once a year, I would suggest anyone on this call should be doing with their investments. We're getting near the end here. For those looking for or interested in some of the more speculative or active-like investment strategies, you'll be probably familiar with the concept of active or smart beta ETFs, which basically is taking the index and applying some sort of filter or criteria that tries to, for lack of a better phrase, capture some sort of smarts or edge, if you will. You'll see ETFs with labels like strong bear, minimum volatility, lots of high yield type ETFs or leveraged ETFs. I'll touch on two. Strong bear is an obvious suggestion that that's an ETF that goes up when the market goes down. So it is an ETF, but it's much more of a bet. You're really taking a position that you think the market's going to go down. Leveraged ETFs are, as advertised, they use leverage so that if you buy a leveraged ASX 200 ETF and the ASX goes up 1%, you're going to go up more than 1%. But it also means the opposite's true. So it's a little bit riskier. So you need to know what you're getting into. I mentioned earlier you can pick more specific sectors and regions with the number of ETFs that are in the market now. I mentioned the tech ETFs. If you owned one of those, it's done really well versus, say, a transportation ETF. That's fine. That's great. It gives people ability to research and pick sectors. The issue that it can happen, to state the obvious, is some people will decide now to buy the tech ETFs, and arguably that run's already happened. So you really need to know, do your homework if you're going to kind of start zeroing in on specific sectors. Most of the ETFs that have an element of sophistication or complexity to their index will have something along the lines of backtesting of this ETF demonstrates its effectiveness and outperformance against, say, a normal or basic ETF. I'll just say that backtesting is no guarantee of future performance. I will call out one example here because I watched it at the time and was sort of frustrated watching this unfold. There was a dividend harvester ETF. This is a beta shares ETF. We use beta shares ETFs in our portfolio. They do a great job at what they do. This particular ETF had an index, a rules-based index, where it bought high-yielding ASX 200 companies right before the dividends paid, and they used derivatives to sort of manage risk around that. So the expense was sort of high, and it had a dividend yield of north of 10% on the surface. And this was a year or two ago when investors were eagerly hunting yield. So this was a ETF that was phenomenally popular for a little while because of the headline yield aspect. The problem with it was the capital appreciation. Returns are a function of yield and capital appreciation. And for technical reasons I won't go into, the capital appreciation struggled for with regard to the companies that ended up being the investment components of this ETF. So the yield was high, but the capital appreciation was not. And so over the last 1, 3, and 5 years, it's actually had negative returns, but a high yield. So you just need to be careful on what kind of ETF you're getting into if it's a bit more exotic. That's the learning there. Our investment committee outlook. So our investment committee is Brian Watson, who's my co-founder, who was one of the founding guardians of the Future Fund, which is effectively the sovereign wealth fund of Australia, so asset allocation for the country, so to speak. Lindsay Tanner, the ex-finance minister, and Mark Nicholson, who's the ex-chief investment officer of the World Bank. So a pretty competent group that oversees our asset allocation parameters and ETF selection process. They meet at least once every 2 months. They're not a token group. We had a meeting yesterday, actually, which was fair to say quite interesting. In summary, here's our views on things. The investment committee's mandate is to look at structural, medium to long-term risk-reward profiles of asset classes. We are not into near-term tweaking of portfolios. That's generally how fund managers get into and investors get into sort of problems trying to respond quickly to short-term events. That being said, we certainly discuss what's going on in the market today. And we're not alone in this view that there is not nearly enough data to make a confident prediction about what the world's going to look like and what the economic world and the share market and interest rate and bond world is going to look like in over 6 to 12 months. The obvious drivers of that are how quickly is a vaccine going to get surfaced? What is the depth and duration of the second wave? And that's obviously applicable to Australia, but really applicable in the US. The US is just fact is a big driver of global markets. What does the recovery and the resilience in the US look like? That remains unclear, and the election remains unclear. And so we'd be jumping at shadows a bit by trying to sort of fiddle too much with the portfolio right now, but we're constantly monitoring this. And China's a big driver of the view as well, particularly for Australia. So that being said, a key takeaway from the meeting was that we are in an even lower for longer interest rate environment, and that has probably been further solidified over the last several months. So there are some long-term implications with that assessment, that interest rates are going to remain very low for 3 to 5 years, if not longer. And over the medium to long term, that's actually a positive for growth assets or equities, in part because equities are typically priced on future profits and earnings, and the lower interest rates, the more value those are. That's one of the drivers of why all the tech stocks have really taken off. And also because if interest rates are very low, you're not going to make much on cash deposit savings and other defensive assets. So it tends to sort of push the flow of funds into equities. So we are likely to increase our exposure to international shares and decrease our exposure to Australian shares, in part because of the structural dynamics of what the international share markets provide versus Australian shares. We are not reducing our share exposure based on what people may view as a dangerous equity share market situation today. We're in the medium to long term, that doesn't come into play right now, in our view. We are reassessing global property and global infrastructure. That will depend on what the next 6 to 12 months play out. So our view is that it's better to be invested than not, but you need to think about whether your asset allocation is right for your situation. Just touching on what Six Park does, I've referred to this a few times already. We have an online risk assessment. You can have a look at that. You can actually take it and get a recommendation with asset allocation guidance, and not have to open an account. People ask why we do that. If you could take that guidance and do it yourself if you want. What we then do is we'll help set up a CMA account and a brokerage account. We'll then do the trade execution for clients, and then do the portfolio reporting. That's where Sharesight comes into play. We also do the rebalancing, as I mentioned earlier. So for what I would suggest is a relatively low fee, we actually do a bit of the heavy lifting involved after an asset allocation decision is made. Always like to end a presentation with a few quotes. With regard to ETFs, Jack Vogel, the founder of Vanguard, most of you probably have heard this: don't look for the needle in the haystack, buy the haystack. I think that's as relevant now as it's ever been. As well as the next quote: investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That was Paul Samuelson, who knows a bit about investing. I think that's a particularly apt comment, given what's happened with COVID and what some people are doing with their superannuation drawdown. So again, I applaud those on the call who are thinking about using ETFs for portfolio construction, or at least a portion of your investment management. I think that's a really, really smart thing to do right now. And my suggestion is really just have a think about asset allocation. And as you are selecting ETFs, just make sure you understand what you're getting into. If it's not what I would call kind of a plain vanilla ETF. That's it for me. I am more than happy to take emails with any questions about the presentation or what Six Park does. That's the URL to the website, and there's heaps of information on there about what we do, why we do it, how we do it, who does it, our ETFs and how we select them, and how robo advice works. So have a look, and thanks for indulging me for this time, and happy to answer some questions.
Perfect. Thank you so much, Pat. That was fantastic. We've had lots of questions come in. So if you could stop sharing your screen so we can see your face, that would be great, please.
Yeah.
Perfect. And just put your camera on.
Okay.
There we go. Thank you.
Yeah.
So we've had a lot of questions kind of come in about ETFs. So I'll ease you in with, do ETFs pay dividends?
They do. They do. So if you think of it, of the index as comprising a bunch of constituent companies, they pay effectively the combined dividends of those companies. The only dividend that would not pay, the only ETF that wouldn't pay a dividend would be a commodity ETF like gold.
Okay. And you mentioned a fact sheet in your, like using an ETF fact sheet to kind of work out what ETFs to buy. Where do you kind of access those?
So if you were thinking about a Vanguard ETF, you could go to the Vanguard site. You could look up asset classes or different types of ETFs. And pretty much every ETF provider, once you get to any information about that ETF, will have a link to, literally it'll say fact sheet, and it'll be a 2-pager. And or you can do the simple thing, which I do all the time, type in the ticker or the asset class or the fund manager and just type in fact sheet, and somewhere on the first page it'll come up.
Perfect. Thank you very much. Can you tell us a bit about why you and Brian set up Six Park and kind of where it all came from?
Yeah, sure. I'm from the US. I moved to Australia about 20 years ago. I've been in the financial services industry for a while, and but I haven't been in the sort of the front end of financial advice till we set up Six Park. We set it up because we saw that it was too hard, expensive, or confusing for most people to get investment management help. And the Banking Royal Commission, as well as a variety of other things, have surfaced that the financial advice industry is not highly accessible to most people. So what we wanted to do, given that we did know a bit about asset allocation and investment management, was basically use technology to be able to distribute a service to people that otherwise couldn't access it, and importantly, couldn't afford it. So that's basically it in a nutshell. And the ETF market in Australia was growing at a time when we thought about this, and ETFs are the building blocks. So the timing was right. About 6 years ago, we decided to have a crack at it, and we launched about 4 years ago.
Cool. Okay. Oh, sorry. That's just one of our computers pinging. So we've had a question kind of come through saying, if you were to buy into the VAS and VGS, would that kind of be a good approach to having kind of a bit more diversity to your portfolio, kind of by buying into a couple of ETFs that are really diverse?
Yeah, I think so. If I understand that one, it's if you don't want to be, if you want exposure to Australian equities, you can get that through one ETF that tracks the ASX 200, or you could buy an ETF that tracks the ASX 200, the ASX 300, high yield components of the ASX, so on and so forth. You would be getting a measure of additional, probably, diversification by spreading your investments across a couple different ETFs that, say, track Australian shares as an asset class. I don't know if you would get a lot more in terms of returns, because most of them will be pretty closely correlated. And so you'd have to weigh off that benefit with, say, transaction costs. Our view is that the ASX 200 gets you what you need for Australian shares. But if you wanted additional diversification within the Australian share asset class, there's nothing wrong with crossing that across a few different ETFs.
Okay. Is there any particular ETF at the moment that you're keeping an eye on that's kind of sparked your interest?
I think I'll be quite candid, because I don't want to present everything as particularly rosy. We love, I'll try to give one, maybe two examples. We love infrastructure as an asset class. I mentioned that in the presentation. Infrastructure has taken a beating because of COVID. So we are keeping a close eye. This was a big part of our investment committee meeting yesterday, was just a refresh on infrastructure as an asset class. And we remain very, very much of the view that it's a great asset class. And that when the when the global economy sort of starts to get on its footing, the first area where governments are going to start to spend a lot of money is going to be probably infrastructure related. So it's taken a beating, but we like the outlook for infrastructure. So that's one that we're keeping an eye on because it's in our portfolio, but it's been particularly impacted by COVID. The others would be gold. We have had consideration of gold as an asset class and have made the decision not to have it in our portfolio for fundamental, structural, medium to long-term reasons about gold. Now, gold's had a pretty good run in the last 3-6 months. And we're continually reviewing, well, does that mean we should add it to our portfolio construction? And our decision yesterday was no, for the same reasons we didn't at the beginning. But we do constantly review that. That's why the investment committee is pretty important and I think a real valuable part of the service. We do keep an eye on whether or not asset classes have fundamentally or structurally changed in their risk reward profile, because that's how you build portfolios and use mean variance optimizers and other tools. So probably the infrastructure one's the main one.
Cool. How much consideration do you give to the size of an ETF?
We give, I'd say we give a lot of consideration to it, but we never have to spend a lot of time thinking about it, because one of the things because if you think of the other considerations I mentioned with regard to the track record of the issuer and how long the ETF's been in the market, therefore demonstrable track record of that ETF, the tracking error, et cetera, we almost always land on an ETF that's, or a couple ETFs to decide from that are at least a few hundred million in size, if not more. There have been, for example, I think it was the global listed property ETF that is in our portfolios, DJRE. When it first listed, it wasn't very big. We wanted that asset class in our portfolio because of the characteristics that a global listed property adds in terms of diversification. So we actually waited till it was, I forget the exact number, maybe 50 million in terms of funds under management. And that just really meant that there was enough liquidity. We could see that there was enough liquidity in it that we wouldn't sort of hit any real road bumps possibly if we put a large trade on. So it is an important decision. I would suggest for anyone on the call, if you're looking at an ETF that's got 1 or 2 million in funds under management, think about how much exposure you might want to have to that, and try to understand why that's a small number, a relatively small number.
Perfect. Thank you so much, Pat. Unfortunately, that's all the time we have for today. So thank you, Pat, for kind of doing your presentation and answering all of our questions. And thank you, everyone, for joining us this afternoon. We really appreciate your time, and have a lovely rest of your day. I'll let Pat say goodbye to you as well.
Well, again, thanks everyone for taking time out of unusual backdrop. And Jess, thank you, and Sharesight for putting this on. Jess isn't paying me to say this, but if you're looking for a really simple, effective way to manage your investments, and in particular to have good insights as to how they're performing, which is phenomenally important, and all you need to do is read the business section every day to see where people are kind of getting disconnected with how their portfolios are performing. A tool like Sharesight's great. It's why we chose them as our partner.
Oh, Pat, you can come back. Everyone, just to let you know that we will be emailing out a recording. We've had lots of people kind of asking about the slides and stuff. We will be emailing out a recording of this webinar so you can watch it again. And there will be more information about Six Park in there, so you can kind of find out more about them. I definitely recommend kind of giving their questionnaire a go and checking out their website, because they are a great partner of ours. So thank you very much, and have a lovely rest of your day. Cheers.
Thanks, Jess.